Okay, so you want to open a payday loan store. You're picturing a small storefront, a folding table, a cash drawer, a line of people on a Friday afternoon who just need $200 to make it to their next paycheck. Low overhead, simple product, fast money in, fast money out. Here's the number that changes that picture. 391%. That's the average annual percentage rate on a standard payday loan in the United States in 2025. Not a scam rate, not a worst-case outlier. The average. In states with no rate cap, it climbs past 600%. In Texas, a single $300 loan can cost a borrower over $700 in fees before it's paid off. And the entire business, every projection, every store lease, every hire, is built on one quiet assumption, that most of the people walking through that door will not be able to pay the loan back on time. Not won't. Can't. Every payday loan in this country runs on the same silent countdown, 14 days. Sign the paperwork, and that clock starts immediately, whether you notice it or not. That's not a flaw in the payday lending model. That is the payday lending model. And by the end of this video, you'll understand exactly how a 14-day loan for $375 turns into a system that moves over $41 billion a year, and why the industry doesn't just tolerate borrowers who can't pay on time. It depends on them. The illusion is simple. This is emergency credit. A bridge. You borrow a few $100s on Monday. You pay it back when your paycheck lands on Friday, and the loan disappears from your life as fast as it entered it. The reality is a $41.12 billion industry in 2025, projected to reach $51.68 billion by 2030, and it isn't built around the borrower who pays back once and leaves. Start with the loan itself. The median payday loan in the United States is $350, borrowed for a term of 14 days. The median fee is $15 for every $100 borrowed. Annualize that fee the way every other form of credit in America is required to be annualized, and you get 391%. For comparison, the average credit card APR in the same period sits somewhere between 20 and 30%. A payday loan, structured as a 2-week product, runs at more than 10 times that rate before a single missed payment. State regulation is where that rate stops being one national number and starts depending entirely on which side of a border you're standing on. In Colorado, which caps total loan costs tightly, the average APR on that same kind of loan lands around 129%, still expensive, but a different universe from the states with no cap at all, where APRs can reach 582% or higher. A $300 loan carried for 5 months costs a Colorado borrower about $172 in interest. The identical loan, carried the identical 5 months, costs a Texas borrower around $702, roughly 4 times as much, for the exact same product, the exact same amount, the exact same term. And the loan isn't secured by your car, your house, or any physical asset. It's secured by something simpler and, for the lender, more reliable: access to your checking account. You write a post-dated check, or you authorize an electronic debit, and the lender now has first claim on your next paycheck before your rent does, before your groceries do, before anything else does. That's the mechanism. Now here's where the illusion breaks. The Consumer Financial Protection Bureau studied more than 12 million storefront payday loans over a single year. The finding: 80% of payday loans are rolled over or reborrowed within 14 days. Not paid off, rolled over. And when you follow those loans further, the picture gets sharper. Over 60% of all payday loans are made to borrowers already in a sequence of 7 or more loans in a row. Roughly half of all loans go to borrowers in a sequence of 10 or more. And nearly 1 in 4 initial loans is reborrowed 9 times or more, with the borrower paying far more in fees than they ever received in credit. 7 loans in a row, 10 loans in a row, 9 reborrowings on a single original loan. Each threshold is higher than the last, and each one describes the same customer, not the exception, but an ordinary outcome the business is built to expect. The typical payday borrower is indebted a median of 199 days a year. That's 55% of the calendar spent owing money on a loan that was marketed as a 2-week fix. The Pew Charitable Trusts, tracking the same market from a different angle, arrived at a compatible picture. The typical borrower ends up indebted for roughly 5 months of the year, even though the loan itself is structured, priced, and advertised as something you resolve in 14 days. Two research organizations, two separate datasets, and the same underlying story, a product built around a due date that most of its customers were never actually going to meet. And here's why Can't Pay so reliably turns into roll it over instead of default and walk away. The lender doesn't have to chase you. It already has a claim on your bank account. The moment your paycheck lands, the lender's electronic debit is often first in line, ahead of rent, ahead of groceries, ahead of the light bill. Defaulting isn't really a choice you make. It's what happens only after the lender has already tried and failed to take the money automatically. So before we get to the storefront itself, it's worth understanding why that storefront can even exist in 50 different versions across the country. Because the barriers standing between you and this business aren't the ones a normal retail founder would expect. So let's say you still want in. Here's what actually stands between you and a functioning payday loan store. And it isn't what you'd expect. The first barrier isn't capital. It's geography, because in the United States, payday lending isn't governed by one national rulebook. It's governed by 50 separate ones. Roughly a dozen states and the District of Columbia ban high-cost payday lending outright, usually by capping all consumer loans at 36% APR or lower, the same ceiling the federal government imposes on lenders serving active-duty military under the Military Lending Act. Illinois, Colorado, and Virginia have all tightened toward that 36% line in recent years. Ohio caps payday APRs at 28%, and the result has been fewer stores and lower borrower costs. Proof the cap actually changes the economics, not just the paperwork. Then there's the other end of the spectrum. States with no meaningful rate cap at all, Texas among them, where APRs routinely clear 500, sometimes 600%, and a $300 loan carried for 5 months can cost a borrower more than double what it would cost in a capped state like Colorado. So the first hidden cost of this business isn't a line item. It's a map. The exact same storefront, the exact same loan product, can be illegal in one state and wildly profitable 90 miles away in the next one. That map problem created an entire second industry, workarounds. The most notorious of these is what regulators call rent-a-bank, a payday lender partnering with a state-chartered bank in a state with no rate cap, then exporting that bank's charter and its interest rate privileges into states that would otherwise ban the loan entirely. The bank collects a fee for lending its charter. The payday company runs the actual operation, keeps the actual risk, and keeps the actual profit. The more aggressive version of the same idea used tribal sovereign immunity instead of a bank charter, and we'll come back to exactly how that ended, because it ended in a federal courtroom and a 16-year prison sentence. Beyond the legal maze, the physical costs are almost embarrassingly low next to what you'd expect from a licensed lender. A payday storefront doesn't need a vault, an underwriting department, or a credit analyst. It needs a location, a point-of-sale terminal, a state lending license, compliance training on disclosure law, and access to the ACH banking network so it can debit a customer's account on the due date. Compare that to a bank branch, which needs deposit insurance, capital reserves, and federal examiners walking through the door twice a year. That gap is exactly why storefront payday lending grew, for decades, into one of the least capital-intensive licensed financial businesses in the country. More than 18,200 storefronts nationwide at the industry's peak, collecting an estimated $7 billion a year in fees, spread across strip malls, standalone kiosks, and check cashing counters that already had most of the infrastructure in place. The product doesn't need a warehouse. It doesn't need inventory. It needs foot traffic near a paycheck cycle and a state that allows the rate. That's also why the industry's center of gravity is shifting online. Digital origination now accounts for a rising share of new payday and payday installment applications, since a website can serve a borrower in a permissive state without paying rent in 50 of them. It's the same underlying license requirement, just delivered through a server instead of a storefront. And it removes the one cost a physical location could never avoid: real estate. Online lending also introduced a layer that barely existed in the storefront era: the lead generator. These are marketing operations, often unlicensed to lend a dollar themselves, whose entire business is collecting a borrower's application, name, bank routing number, income, social security number, and auctioning it to the highest bidding licensed lender in real time. The borrower thinks they applied to one company. In practice, their financial data may have just been sold to several. It's a barrier to entry in reverse. Instead of blocking new operators, it lowered the cost of acquiring a customer so far that anyone with a licensed lending partner and a well-placed search ad could enter the market without ever opening a physical door. That low physical cost is exactly why the real barrier to entry isn't the storefront. It's the license, and increasingly, it's the compliance apparatus layered on top of it. The CFPB's Payment Provisions Rule, which took effect in March 2025, added a new requirement. After 2 consecutive failed attempts to debit a borrower's account, the lender needs fresh authorization before trying again. Enforcement of that rule has so far been limited. But every new rule adds a new cost that a 2-person storefront in a strip mall has to absorb the same way a 400-location chain does. Which is exactly why, over the last decade, the market has consolidated around a handful of large operators instead of thousands of independent shops. And there's one more hidden cost, paid entirely by the borrower rather than the operator, the military exemption. Because the 36% cap under the Military Lending Act only protects active duty service members and their dependents. In 2025 alone, the CFPB reached a $9 million settlement with First Cash over Military Lending Act violations. A reminder that even the one bright line meant to protect a specific group of borrowers still gets tested, and sometimes crossed, in a market this large. Here's where the business model stops looking like a corner store and starts looking like something closer to a subscription service. Except the subscriber never chose to subscribe, and the product is debt. The visible cash flow is simple. Customer borrows $375. Customer owes $520 in total by the time the loan is repaid, according to CFPB's own estimate of the typical payday borrower's cost. That $145 gap, roughly 39% of the original loan, is the lender's gross revenue on that single transaction. But that's not where the real money is. The real money is in the loan that doesn't get repaid on time. Think about the incentive structure for a second. If a borrower pays back a $375 loan in 14 days and walks away, the lender made one fee and now has to find a brand new customer to replace that revenue. If that same borrower can't pay and instead rolls the loan over, paying the fee again just to push the due date back another 2 weeks, the lender makes that same fee again on the exact same $375 without acquiring a single new customer, without a new credit check, without any new marketing spend. One borrower who rolls over 4 times generates the same fee revenue as 5 separate borrowers who each pay off their loan once. And rolling over is dramatically cheaper for the lender to produce than acquisition. No new underwriting. No new customer acquisition cost. Just a phone call, or these days, a checkbox on a screen. Run that math forward across a whole storefront. A single location might carry a few hundred active loans at any given time. If even a third of those customers roll over twice before finally paying off or defaulting, the store's effective revenue per original loan climbs well past that first $145 fee, without a single additional customer walking through the door. That's the entire logic behind why payday chains spend so heavily on customer acquisition up front and almost nothing on retention afterward. The product itself, structured around a due date most borrowers can't meet, does the retention work automatically. That's why the CFPB's own numbers point the same direction from every angle. 3 out of 5 payday loans go to borrowers whose total fees, over a loan sequence, exceed the amount they originally borrowed. In Florida, one of the few states that publishes granular loan count data, borrowers who take out 10 or more loans in a year make up just 16% of all borrowers. But they generate 42% of all transactions in the state, 16% of the customers, 42% of the business. That's not a bug in the model. Pew Charitable Trusts and the Center for Responsible Lending have both pointed to the same underlying structure. The loan is priced and timed so that a single paycheck almost never covers both the loan repayment and the borrower's other bills in the same 14-day window, which quietly manufactures the very reborrowing that generates the lender's best customers. And even when a borrower does everything a regulator says they should, asks for a no-cost extended payment plan instead of another rollover, which most payday lending states require lenders to offer, The CFPB found in its most recent research that very few borrowers actually use them. The plans exist on paper. The rollover fee is what borrowers actually pay, because the lender has far more incentive to steer a struggling customer toward renew than toward restructure for free. Layer the debit authorization on top of all of this, and the collection side of the machine runs almost entirely on autopilot. The lender doesn't need a call center chasing down late payments the way a credit card issuer does. It just resubmits the electronic debit. If it bounces, the borrower's bank charges an overdraft fee, a cost the Payday lender never pays and rarely even sees, but one that stacks directly on top of everything the borrower already owes. Compare that collections cost to a traditional unsecured lender. A credit card company that misses a payment has to run a full collections operation, statements, phone calls, sometimes a charge-off and a sale to a third-party debt collector, recovering pennies on the dollar months or years later. A Payday lender's version of collections is a resubmitted debit request that costs almost nothing to send and, 4 times out of 5, produces another fee instead of a write-off. The entire cost structure of chasing a late payment, the single most expensive part of consumer lending almost everywhere else, has been engineered down to nearly zero. That's also the quiet reason the earned wage and cash advance apps now competing for the same customer look, on paper, gentler than a Payday loan and still land in a similar place. The CFPB's own review of employer-linked wage advance products found transactions growing more than 90% in a single year, with the illustrative APR on a typical advance still running around 109.5% once fees and tips are annualized, far below 391%. But still many multiples of a credit card on a product marketed as a modern, friendlier alternative to the Payday store next door. And as we're about to see, when a system is built this precisely around customers who cannot pay on time, the version of it that pushes hardest, that decides state law is optional, is also the version that eventually collapses the fastest. By the early 2000s, Scott Tucker was not a typical Payday lender. He was a professional race car driver who had found a far more lucrative business on the side, online Payday lending, run out of Kansas, extending short-term loans to customers in nearly every state in the country, including states where Payday lending at his rates was flatly illegal. For years, individual states tried to stop him. Several attorneys general filed actions to shut his operation down or force it to comply with local usury caps. And for years, Tucker had an answer ready. His lending companies, he claimed, weren't really his. They were owned and operated by Native American tribes, the Miami tribe of Oklahoma and the Modoc tribe of Oklahoma among them, which meant, on paper, they were protected by tribal sovereign immunity, a legal doctrine that generally shields tribal governments from state law enforcement. It was, prosecutors would later say, a fig leaf. Behind the tribal paperwork, federal investigators found that Tucker controlled nearly every part of the operation: underwriting, marketing, customer service, collections, while funneling billions of dollars through nominally tribal bank accounts specifically to obscure his ownership. The tribes, according to the government's case, received a small fraction of the profits in exchange for lending their name and their legal shield. The scale, once investigators reconstructed it, was staggering. Over more than 15 years, Tucker's operation extended loans carrying interest rates as high as 1,000%, not 100, 1,000, to millions of borrowers across the country. Prosecutors ultimately tied the scheme to $3.5 billion in proceeds. At trial, Tucker's defense didn't dispute the rates. It argued the loans were legitimate commercial transactions, that borrowers had agreed to the terms in writing, and that the tribal partnerships were genuine business arrangements rather than a shield. The defense called no witnesses of its own, relying instead on cross-examining the government's case. The jury didn't buy it. On October 13, 2017, after a 5-week jury trial, a jury convicted Tucker on all 14 criminal counts against him: racketeering, wire fraud, money laundering, and violations of the Truth in Lending Act. His attorney and co-defendant, Timothy Muir, who had helped design and paper the tribal arrangements, was convicted on racketeering conspiracy as well. On January 5, 2018, U.S. District Judge P. Kevin Castile handed down the sentence: 200 months, 16 years and 8 months in federal prison for Tucker, one of the longest sentences ever imposed in a consumer fraud case, well above the standard sentencing guidelines. Timothy Muir received 84 months. The court also ordered Tucker to forfeit the $3.5 billion the government said the scheme had generated. Judge Castel's words at sentencing were direct. The tribal arrangements were nothing more than a fig leaf over what he called a predatory scheme, one designed to evade state usury and consumer protection laws while extracting the maximum possible amount from people who were already living paycheck to paycheck. Two more details close the loop. Two of the tribes Tucker had used later reached their own settlements. A further $3 million added to the hundreds of millions already recovered from Tucker and from U.S. Bancorp, one of the banks that had processed his payments, to compensate the borrowers his operation had defrauded. Prosecutors framed it plainly. For more than 15 years, Tucker and Muir made billions of dollars exploiting struggling, everyday Americans, and when states tried to stop them, they hid behind tribes that received only a sliver of the profit in exchange for lending their sovereignty. And the model itself didn't disappear with Tucker's conviction. Tribal lending partnerships and rent-a-bank arrangements are still active in the market today, operating within tighter legal boundaries and under far closer regulatory scrutiny than Tucker ever faced, because the 14-day clock and the demand it feeds on never actually went anywhere. Only the specific operator did. Every subsequent tribal lending arrangement in this industry now operates in the shadow of a single fact. The Justice Department has already shown it can unwind one of these structures, trace the money through it, and put the person at the top of it in federal prison for 16 years. So if the borrower is structurally set up to lose, and Scott Tucker proved that even the operators who cheat can eventually lose too, who is actually winning? Start with the large, licensed chains that never needed a tribal workaround in the first place. Advance America, Check into Cash, ACE Cash Express, Speedy Cash, multi-state operators with the compliance budgets to survive 50 different rulebooks, something a single independent storefront can't match. Scale doesn't just add revenue in this business. It absorbs regulatory cost, which pushes the market toward consolidation every time a new rule gets added. Then there's the banking side. In the rent-a-bank model, a state-chartered bank collects a fee for lending its charter and its interest rate exemption to a payday company operating in states that would otherwise cap the rate, carrying almost none of the underwriting risk because the payday company services and owns the actual loan. There's the state itself, in the states that permit the industry, licensing fees, registration revenue, and, in states without a cap, a local tax base built partly on interest income that would be illegal one state line away. Even federal regulators end up, in a narrow sense, part of the machine. In 2025, First Cash, one of the country's largest pawn and consumer lending chains, paid $9 million to settle Military Lending Act violations. The settlement punished First Cash. It also became, quietly, revenue on the government side of the ledger. And there's the float on the other side of every missed payment. When a debit bounces, it's the borrower's own bank that collects the overdraft fee, a cost that stacks on top of the payday fee without the payday lender ever touching it, and without the bank taking on any of the payday lender's risk. While the borrower is measured in days spent in debt, a median of 199 days a year, the winners in this system are measured in basis points of risk avoided. The bank that never underwrote the loan, the tribe that lent only its name, the chain large enough to treat compliance as a fixed cost spread across 400 locations instead of one. Not because any single actor set out to trap someone. Because the fee structure, the debit authorization, and the 50-state patchwork all point the same direction at once, toward the version of the transaction that gets repeated, not the version that gets closed. Even regulation itself becomes a kind of asset for the largest players. Every new disclosure rule, every payment provisions requirement, every state that tightens its cap toward 36% pushes the smallest independent operators out first. They're the ones without a compliance department. The chains with 400 locations absorb the same rule as a rounding error and inherit the customers the smaller stores can no longer legally serve. And as we're about to see in the closing math, none of that consolidation changes what happens to the person standing at the counter on day 14. Go back to that 14-day clock from the start of this video. It starts the moment you sign. And for the roughly 12 million Americans who take out a payday loan every year in the states where it's still legal, That clock rarely stops after just once. 4 out of 5 of those loans get rolled over before it runs out. Nearly 1 in 4 gets reborrowed 9 times or more. And the industry that built all of this, $41 billion this year, projected past $51 billion within 5, didn't get there by lending money to people who pay it back on time. Scott Tucker spent 15 years betting that the fastest way to profit from that 14-day clock was to make it invisible to state law entirely, and he built a $3.5 billion operation before a federal courtroom finally caught up with him. The lenders still standing today didn't disappear that math. They just learned to run it inside the lines instead of outside them. Look at the two states side by side one more time. In Ohio, a 28% cap left fewer stores and lower borrower costs. In Texas, no meaningful cap at all leaves the exact same $300 loan costing more than double, and the industry, both times, kept operating, just at a different scale, with different owners, and a different set of survivors. So the question isn't really whether a $375 loan can save someone in a genuine emergency. Sometimes it does. The question is what happens on day 15, and whether the system in front of you is ever actually designed to help you reach it, or simply built to be there again when you don't.